All right, S&P 500 futures are, well, they're absolutely flat this morning. It's Friday, January 2nd, and we're hovering right at a neutral implied open. I'm seeing just what, plus 0.05% in the overnight session. So if you're looking for a clear direction to kick off 2026, you're not going to find it yet. This is such a classic wait and see tape as the institutional desks are, finally shaking off the holidays and trying to rebalance.
And that tension is exactly what's behind this lack of direction. We have a major conflict playing out on the screen right now. You've got the historical tailwind of the so-called January effect running smack into the wall of the 2026 guidance pivot. The market is trying to weigh a cooling labor market, which is bullish, right? But it's weighing that against the headwind of new, pretty disruptive trade tariffs.
It really feels less like a market and more like, I don't know, two opposing narratives just wrestling for control of the anchor position.
That's it exactly. And that's the core question, isn't it? For every single trader on the street today, is the AI productivity miracle narrative going to outrun the very real risk of an inflation 2.0 headwind? Because until that's resolved, we're just choppy. You have to respect the range. So, I mean, the hook is this. Is today the start of a new bull leg for the year, or are we walking into a 2026 valuation trap that just snaps shut at the opening bell?
Okay, let's unpack that with the liquidity flows, because while the indices are glued in place, we are seeing some clear concentration in the pre-market movers. The Nasdaq futures, the NQ, they're definitely leading the S&P, which tells me that any money coming back in this morning is prioritizing semis and AI infrastructure. Think SMH and XLK. We're seeing a clear transition from, AI hype to AI utility.
It's all about picks and shells now.
Exactly. Institutions want the hardware cycle, not just the dreamers anymore.
Well, it's the most capital-efficient sector right now. Money is always going to flow to the most reliable growth engine first, especially when the macro picture is this murky. They're placing their bets where the visibility is clearest.
And the undisputed magnet for that early liquidity is NVIDIA. NVDA, it's up, 1.2% pre-market, trading on some fresh institutional buy ratings that hit the tape overnight. For any trader, NVDA is the bellwether today. We have to watch its internals.
And what's so fascinating here is that the immediate catalyst isn't Q4 earnings, it's the forward view. It's all about the transition from the Blackwell platform to the next-gen Rubin platform. This anticipation is being fueled not just by the domestic AI build-out, but by this sort of unmodeled China reopening demand for H20 equivalent chips. That's a huge new variable that most models just haven't priced in yet.
So for the active trader listening, what are the lines in the sand for NVDA? Where's the bet?
Okay, so for the bull case, the key institutional resistance is 165. That's the high water mark. A clean break above 150, which was that huge resistance at year-end, opens up what we could call the golden path to 165. It signals confirmation.
But if that momentum stalls, if the broad market just stays stuck in this range, we know those gains get trimmed fast. So where's the safety net?
The absolute must-hold floor is $132, but the immediate warning shot, the first red flag, is $140. If it fails to hold 140, that triggers mean reversion right back to the 50-day EMA. And, that 50-day is probably the single most important line for institutional risk models. If we lose it, you'll see the value-tilted hedge funds start trimming concentration risk immediately. Selling pressure comes in fast.
Okay, moving to the other side of the tape. The other high relative volume name is Tesla, TSLA, and it's seeing some pain, down 2.1% pre-market. The street is absolutely bracing for a soft Q4 delivery report today. I mean, that psychological 423,000 unit floor is looking really shaky.
It is. The delivery news is a major headwind. But look at the volume. Even on the dip, the volume is high. That high relative volume isn't just about last quarter. It's about the forward-looking story. We've got news that Cybercab mass production is actually ahead of schedule for Q1 2026. This robo-taxi pivot is really the only thing structurally keeping the stock afloat if those deliveries miss badly.
So the narrative has completely decoupled from vehicle margins. The market is trading it like a fleet sauce company, not a car company.
Exactly, which is why the key institutional resistance, the level that confirms this pivot story is working, is $485. That number represents the pivot into that crucial $1.5 trillion market cap territory. A high volume push through 485 gives the bulls real control.
And what if we do get that sell the news reaction to the delivery miss? Where's the danger zone?
The bear case takes us down to 410 pretty fast. That's the necessary gap down to retest the psychological support at 400. If we hit $400, that's where the real institutional battle space begins. You'll see massive volume, volatile whipsaws. Funds will have to decide right there if the robotaxi story is worth defending.
Now, here's a fascinating rotation signal, and it's completely outside of tech. Cigna Group, CI. This stock is seeing really high relative volume, up a massive 30% in the pre-market. That is not normal noise.
No, that is a clear, definitive signal of institutional rotation into defensives. Let's be honest, the often frothy run-up in high beta tech last year, institutions are starting 2026 by prioritizing balance sheet strength over pure hypergrowth.
So what's the wire catalyst for Cigna? What's driving it?
A fresh, pretty unexpected top value pick upgrade hit the wires. The institutional flow is specifically seeking defensive growth with superior debt management. They're de-risking, they're trading out of high PE tech names and into sectors that generate consistent cash flow no matter what the economic cycle looks like.
The technical breakout here looks incredibly strong for Cigna. I mean, it's clearing multiple resistance points.
It does. The immediate bull case target is 385. That marks a clean technical breakout from its previous falling channel. If it clears 365 on high volume today, you put 400 firmly in play for the month. That would confirm the new valuation regime is underway.
And the floor.
The safety valve, the bear case level for CI, is $340. It's sitting right on top of its 200-day moving average. That's where the smart money would buy the dip. But overall, that 30% jump is a massive flashing sign. Institutions want security first this year.
Okay, that covers the movers. Let's define the battlefield for the indices, because while NVDA is popping and TSLA is dropping, the majors are flat. We need conviction, not just noise.
Agreed. We're in a tricky spot. The high relative volume in single names isn't translating to directional clarity for the market as a whole.
Let's start with the S&P 500 futures, the institutional floor, ES. Our current pivot is sitting right at 6,935. Where does the bullish thesis get confirmed?
The resistance, our line in the sand, is 6,953.50. Reclaiming that specific level opens the door immediately to the psychological 7,000 handle. But, and this is important, without a high volume close above 6,955 today, the Santa rally residue is officially exhausted. You need conviction there. Anything less is just noise.
And what's the risk area below us? The support that, if it breaks, signals a sharp retreat.
That's 6,928.25. A clean break there triggers what traders call a trapdoor effect down to 6,900. If 6,928 fails, you should expect a rapid, probably painful retest of the 6,880 value area.
So the strategy for now is just scalping the range.
Absolutely. Scalp that tight range between 6,930 and 6,950. Avoid any heavy swings until the European Open gives us the volume confirmation we need. You are protecting capital this morning.
Moving to the Nasdaq, the AI momentum check, NQ. Current pivot is 25,435. We know the bulls are pushing through NVDA, but where's the wall of supply?
The key resistance is 25,511. That specific supply zone is holding all those late December trapped buyers. The people who bought the high and are just desperate to sell back to break even. If we don't decisively clear 25,650 today, then the tech sector is just ping-ponging in a distribution phase. It's just burning time.
Okay, so that brings us to the equilibrium point. Where does the weekly bullish bias actually end for the Nasdaq?
That would be 25,358. This is the critical institutional equilibrium level from Q4 2025. Losing this level shifts the entire weekly bias from bullish to corrective.
And for anyone unfamiliar, what does corrective actually mean here?
It means we stop expecting higher highs and start expecting lower lows in the near term. The primary trend shifts. The strategy here is to watch for a liquidity sweep, a quick dip below 25,350 to shake out weak hands for a potential bounce. But you cannot commit to the long side if volume stays this thin.
Okay, we've defined the technical fight. Let's shift to the macro forces underpinning these levels, because that's the real story for the year. The macro dashboard looks almost deceptively calm this morning.
It does, but the forces at play are massive, and they are in direct conflict. We need to talk about the dollar index, the DXY, and the 10-year yield.
That weak dollar, the DXY, is at 98.20, multi-year lows after a huge 9.4% drop in 2025. That's a massive tailwind for mega cap earnings, isn't it? Does the street realize how big that boost is?
Oh, absolutely. You're spot on. A weaker greenback means that all the revenue generated overseas, which is, 50 to 60% for these mega caps, gets a huge boost when converted back to dollars. It's a massive automatic accounting tailwind. It's great for big tech.
And here's the friction point. The 10-year yield, the US 10Y, it is just sticky at 4.16%, only easing 1 basis point overnight.
The 4.16% is the market friction. It's not spiking, which is good, but it remains a firm, non-negotiable valuation ceiling. We are not in the zero-rate AI honeymoon anymore. That yield forces investors to demand Real high-quality cash flow, not just future potential. It punishes weak balance sheets.
So if the tape is flat, despite this big tailwind from the dollar and friction from the yield, what do you call the current state of the market?
We are definitively in a ghost tape, a liquidity trap. A ghost tape means institutional desks are just back. They're using this thin volume for hedging, for careful position management. The volume is concentrated and deep in the money options. That tells you it's about risk management, not fresh capital deployment.
So why are they paralyzed? What's the unseen factor here?
The market is paralyzed because of the political dimension. It's the shadow chair effect. Traders are betting heavily on a potential dovish replacement for Fed Chair Powell later this year. That anticipation is what's keeping the dollar suppressed and preventing any aggressive moves. Until that's resolved, big money stays on the sidelines.
That political tension brings us to the biggest hidden risk for 2026, the pain trade. We talked about the yield being sticky. What happens if the 10Y spikes today, say to 4.25% plus?
The single biggest hidden risk right now is the maturity wall. Retail assumes tech is safe because of AI, but 2026 is the year that all that debt rolls over. People forget that these tech firms issued massive amounts of free money debt back in 2020 and 2021 at near zero rates. That debt has to be refinanced this year at 4.25% or higher.
So the pain isn't just about lower PE multiples, it's a direct, massive increase in interest expense for any debt-heavy mid-cap or legacy tech company. It could turn a profitable company into a cash sink overnight.
Precisely. Billions in new interest payments hitting the income statement. If that yield spikes, you will see a sudden violent rotation out of high-burn, debt-leveraged AI names and aggressively into fortress balance sheet, tech, the companies that held cash.
And for the listener, what's the defensive move here?
Before you commit capital this year, check the debt-to-equity ratio of any growth name you hold. The lesson for 2026 is that cash is no longer trash. It is the only real protection when the cost of capital resets this high. It's the most important portfolio check you can do today.
Okay, let's wrap this with the final strategic directive for the day. It sounds like real, committed institutional direction stays sidelined until next week.
Absolutely. Until that January 9th on-farm payrolls report, we stay range-bound and thin. You just have to respect that.
Oh, the strategy is tight and defensive. Today is about protecting your 2025 gains, not gambling on 2026's first candle. Keep the leash short, trade small, stay liquid. And the final technical call remains. No 6,955, no party.
And here's the provocative thought for you to carry through the trading day. Monitor the 10-year Treasury today. If yields stay steady at 4.16% despite any equity pump we might see, the Goldilocks start to 2026 is real. But this delicate balance is entirely dependent on yields respecting these levels. The NFP report next week will determine if that shadow share is finally cast aside or if the market stays paralyzed. Watch the bond market. It's telling the real story.